Welcome back to the Deep Dive. Today we're plunging into, well, a really striking story of corporate survival and an almost instantaneous pivot in tactics. Our mission is to analyze this pretty extraordinary journey of an insurance holding company. They reported their worst year ever in 2001, only to execute a turnaround so fast that, believe it or not, they logged their largest quarterly profit less than 12 months later.
Yeah, that dramatic speed, losing hundreds of millions one year and then making hundreds the next. That's
Yeah.
what makes this, so fascinating to dissect. We are deep diving into the company's 2001 annual report and then contrasting it directly with their third quarter 2002 shareholder letter. The goal really is to understand how their long-term, very conservative financial philosophy acted as a kind of structural defense mechanism. It allowed them to capitalize when, frankly, the rest of the industry was pretty much paralyzed.
And when we talk about that low point, I mean, it was a genuine disaster, wasn't it? In 2001, the company reported its largest ever net loss, $346 million. And book value per share, which is such a critical metric for insurers, it dropped by 12.2%. Then just 1 year on, they report their biggest ever quarterly profit, $281 million. That's an absolute whipsaw. It's almost hard to believe that kind of loss could flip to a record profit in just, 12 months?
Okay, let's unpack this. Right, let's start with just how deep that 2001 financial hole actually was. Besides the $346 million net loss, the stock price took a 28% hit. But the real story, I think, is in the consolidated combined ratio, that key measure of underwriting profitability. It hit 121%.
That 121%. Yeah, that's really the analytic core of the crisis here. For you, the listener, you really need to grasp what that number means. A combined ratio of 121%. It means that for every single dollar they collected in premiums, they were paying out $1.21 in claims and expenses. They were losing 21 cents on every premium dollar they wrote, just bleeding cash on the core business. And it was their second worst ratio ever, apparently. Wow. Yeah, losing 21 cents on the dollar. That kind of loss doesn't usually happen because of just one thing, right? What were the main body blows that drove that ratio so incredibly high?
Well, there were two main culprits. The first, pretty obviously, was the catastrophic external event, the World Trade Center losses. That hit them for about $288 million, a massive external shock. But the second factor, and this was maybe more painful because it was internal, reserve deficiencies. They totaled $304 million, mostly from their U.S. insurance subsidiaries, Crum and Forster, or CNF, and TIG. And this covered business they'd written in 2000 and even earlier years, so past mistakes coming home to roost.
$304 million in deficiencies.
Yeah.
It's a huge number. And the CEO specifically apologized for these, didn't he? He noted they told shareholders the year before they didn't expect it to happen again. That sounds like a pretty major failure in operational risk management, especially for a company that prides itself on being conservative.
It really was a painful moment. And it kind of exposed the tension between having a conservative management philosophy at the top and the messy operational reality of managing subsidiaries they'd acquired during the late 90s, which was, a period of notoriously bad pricing in the insurance industry. But what's critical here, and the source material points this out, is that this wasn't just their problem. It was an industry-wide issue. The whole U.S. sector reported something like over $8 billion in adverse reserve development in 2001. So yes, they own their failure, but the underlying sickness really undervaluing risk in the years leading up to 9/11 that was systemic. Okay, so the pain of 2001 almost immediately created this, unprecedented opportunity in 2002. The WTC catastrophe, combined with low interest rates and falling stock markets, basically just wiped out capacity across the P&C sector. This created what we call a hard market. What does that mean? Capacity was severely limited, prices were shooting up dramatically, and policy terms got much, much tighter. Suddenly, insurers held all the cards.
Right. And their disciplined balance sheet, which we'll definitely get to, Matt. They were perfectly positioned to jump on this opportunity. They didn't have to retreat like maybe some of their competitors who were short on cash.
Yeah.
And the 2002 operational numbers show they executed immediately and aggressively. Just looking at the first 9 months of 2002, gross premiums written up 22%. Net premiums written up 33%.
Yeah.
They were grabbing market share at these fantastic new prices.
Absolutely. They totally executed on their primary objective, which was getting those combined ratios below 100%. Back to profitability. All of their Canadian companies and their reinsurer, Odyssey, achieved this. You had Commonwealth hitting 93.5%, Federated at 94.8%, really strong numbers. And the total combined ratio for the entire group, it dropped substantially to 103.3% by the end of Q3 2002. And that's what fueled that record profit we mentioned.
It's fascinating, though, that the cleanup wasn't like instant everywhere. TIG was still lagging behind, wasn't it, even into 2002?
Yeah, TIG was The deep-seated problem child, you could say. It needed fundamental restructuring. So they strategically cut TIG's overall net premiums written down by 14%. How? By exiting a lot of risky program business. The kind written through MGAs, managing general agents. Now, the business they kept was actually up 50% year over year, which sounds good, right? But even that growth business still had a combined ratio of 104.2% in Q3, still losing money. So this shows you even a successful rapid turnaround relies on some pretty aggressive triage. You cut off the bad parts fast. The record profits were definitely heavily weighted toward the healthier subsidiaries.
Let's switch gears slightly and talk about the financial engine that drives this whole business, the float. Float can be a bit confusing sometimes. Can you maybe simplify that concept for us?
Sure. Float is absolutely key in insurance. Think of it as, well, it's basically an interest-free loan from policyholders. It's the cash pool made up of premiums collected but not yet paid out as claims, plus loss reserves set aside for future claims. So the insurer holds this money before losses are paid. The goal of any great insurer is to acquire that float for zero cost. What does that mean? It means getting your combined ratio to 100% or less. If you do that, you break even or make a profit on underwriting.
Yeah.
And then you get to invest that entire float someone else's money, essentially, for your own profit. That's the magic.
Got it. And in 2001, because the underwriting results were so bad, the cost of that float was, well, astronomical.
Exactly right. In 2001, they had that huge underwriting loss, $972.1 million on about $6.9 billion of float. That meant the float was costing them 14.1% just to hold. They specifically noted in the report that this cost was vastly higher than, say, the long-term Canada Treasury bond yield, which is only 5.8%. So the whole financial value proposition was completely broken. They were paying way too much for their investment capital. That aggressive turnaround in 2002 underwriting, it was absolutely necessary just to get that float cost back down towards zero.
Okay, so the discipline we saw in underwriting, aggressively cutting the bad stuff and seizing the hard market, that seems mirrored on the balance sheet side too. Let's move to their core investment philosophy. This is interesting. They prioritize growing book value through net income from all sources. And that's a really crucial distinction from how a lot of the P&C industry operated then, isn't it?
Oh, absolutely. That philosophical difference it's everything, really. You see, by focusing solely on what they called operating income, many competitors felt pressured to reach for yield. What's that mean? Taking on riskier bonds, maybe loading up on volatile stocks just to juice up their short-term investment income figures, make the quarter look good. This company did the exact opposite. They deliberately maintained a highly defensive position all through the market bubble years. Why? Because their core philosophy demanded capital preservation first. Survive first, then thrive.
And that defensive stance meant actively avoiding the really obvious bubble risks.
Precisely. You look at their portfolio back then, zero stock or bond exposure in telecoms, none in techs, none in those high flyers like Enron or Tyco that blew up so spectacularly. Their bond portfolio was deliberately very high quality. They consciously sacrificed some short-term interest income for long-term safety. And look, this wasn't just about being prudent. It was a structural defense mechanism. It ensured they had the capital liquidity and the strong ratings needed to write all those new high-margin policies in 2002. While their competitors were scrambling, maybe forced to retreat or raise capital at really bad prices.
Okay, that makes sense. If they avoided risk so well by holding high-quality bonds and steering clear of tech stocks, why'd they still bother to hedge their portfolio? Wasn't the balance sheet safe enough already?
That's a great question. It shows another level of their thinking, right? They understood the difference between, say, individual asset quality risk, like a specific bond defaulting, and broad systemic market risk. They were hedging against the potential collapse of the entire market, which they clearly felt was severely overpriced back then. So they bought S&P 500 put contracts. Think of it like buying catastrophe protection, but for their investment portfolio instead of their insurance business. It was protection against a major broad-based stock market crash. They recognized that even if their own portfolio was full of safe stuff, a 50% market drop drags almost everything down eventually. It impacts consumer confidence, policy demand, everything.
And by the third quarter of 2002, they'd actually realized some gains from that protection, right? The report says the notional value of their S&P 500 put position dropped from US $1.1 billion down to US $400 million.
Yep.
Because the market decline they were worried about had actually happened, generating profits on those puts for them.
Yes, and what's really fascinating here is their mindset, even after realizing those gains. Even after the markets had already fallen about 50% from those crazy dot-com highs, the company remained extremely cautious, still bearish. They argued in the Q3 letter that market valuations were still scary. They pointed out the S&P 500 was still trading around 20 times earnings and maybe 3.5 times book value, still high by historical standards. Plus, short-term interest rates were at 40-year lows, yet the underlying business conditions, outside of maybe housing and autos back then, remained pretty weak. So they kept that conservative position. Why? Because their fundamental analysis told them the bubble had only partially corrected. There might be more pain to come.
Right, this level of financial conservatism, it really gave them a massive capital advantage, didn't it? Let's look at maybe the three pillars of that advantage. First, the foundation. Just how strong was the balance sheet, even after that brutal 2001 loss?
Yeah, the foundation was rock solid, critically no bank debt, and by September 30, 2002, they were sitting on $2.6 billion in cash. That was 16% of their total investment portfolio, just sitting in cash. And their bond positioning, as we said, deliberately defensive. 56% of the bond portfolio was in government bonds, mainly U.S. Treasuries. Super safe, and only 7% of the entire portfolio was in common stocks, very low equity exposure. So they had tons of dry powder ready to deploy when they saw opportunities.
Okay, so solid foundation. The second pillar then is liquidity and flexibility. The strength allowed them to make some key strategic corporate moves even during the downturn, right?
Exactly. The Odyssey IPO back in 2001, that was a really crucial strategic maneuver. It raised about US $434 million in cash and notes for the parent holding company. And at the same time, it actually helped improve Odyssey's S&P rating up to A, very important for a reinsurer. So that IPO did two things. It injected capital right when they needed it most, and it also proved the underlying value of one of their key subsidiaries. It sort of signaled their intent to maybe take CNF public next, assuming markets recovered. They also stated an objective to always maintain a floor of $500 million in cash right at the holding company level, just to ensure they'd never face a liquidity crisis.
Makes sense. So foundation, flexibility. And the third pillar you could say is conviction. The ultimate confidence vote came straight from management in 2002, didn't it? Once they saw the turnaround is really working.
It really was a powerful statement, a real show of belief in their own strategy. The CEO, the directors, key officers, they personally bought as many shares of the company as they could apparently afford. Right after those realized gains from the puts were pre-announced, and they made it crystal clear in the letter. They felt the stock price at that time was, quote, ridiculously undervalued. I mean, that's management putting their own money where their mouth is, where their philosophy is, big time.
And that conviction, it was backed up by the long-term reality, too. Since they started back in 1985, their book value per share had compounded at, 34% annually? Phenomenal. While the stock price compounded at 28%, still amazing, but shows the market sometimes undervalues that steady compounding. So that 12.2% drop in book value in 2001, while really painful at the time, it just became a temporary dip on that long-term compounding curve. It highlights how that disciplined capital preservation really protected the long-term value creation engine. Hashtag tag outro.
So if we try to synthesize this incredible story for you, the listener, what's the core lesson? I think it's this. Their investment defense, avoiding the bubble, using those put options, it wasn't just about preserving capital passively. It was actually a tactical maneuver. Their conservative position guaranteed they'd have the financial strength, the dry powder, and the strong ratings necessary to aggressively attack that high-margin hard market, the market created by the very catastrophe they managed to survive. So discipline on the balance sheet basically provided the license, the permission, to underwrite aggressively in 2002. The two worked hand in hand.
Yeah, and that caution they maintained, even after the market had already dropped 50%. That's the final really compelling detail for me. The source material actually shows these charts of historical S&P 500 price-earnings ratios. And even in the late 2002, the valuation levels were still, by historical standards, extremely high. And the company made this, pretty remarkable forecast back then. They predicted that the bubble highs S&P 500 at 1,552, Dow Jones at 11,755. They said those levels might not be seen again in the next decade, which turned out to be pretty accurate, didn't it? So what does this all mean for your own decision-making as an investor or business leader? I guess the question for you to mull over is this. If fundamental analysis based on history and value is as essential as this deep dive seems to show, then how much weight should you give to those long-term valuation metrics like PE ratios compared to historical averages? Especially during periods when the market seems utterly convinced that, this time is different and the old rules no longer apply. It's a powerful lesson, I think, in valuing patience and fundamental analysis over just following the herd or predicting